In this video, we're going to discuss the difference between a company's equity value and its enterprise value. So the enterprise value represents the value of the entire firm, whereas the equity value is just the value of the equity that pertains to the company's common shareholders. So the enterprise value represents the value of all the assets, regardless of who the capital providers are, debt holders, equity holders, whereas the equity value is looking at that portion of the firm value that pertains to those common shareholders. So we calculate the enterprise value as follows. It's equal to the company's equity value plus net debt, where net debt is the company's debt minus cash and cash equivalents, plus preferred stock if the company has any, plus non-controlling interest if the company has any. Now, we can rearrange this equation as follows to get the implied equity value. And you'll see investment bankers will do this, right? So once you know the enterprise value, you know the net debt, and then, a lot of companies don't have preferred stock, but if they did, preferred stock, non-controlling interest, you subtract these three things from the enterprise value to get the implied value of that company's equity. So let me give you a quick example, and then we'll dive into a little more detail. So let's say a company's enterprise value is $7,516. The company has $3,000 of debt, $850 of cash. So right off the bat, you can see the net debt is going to be $2,150. Because it's the debt minus the cash. You assume that the company could just take that cash they have and pay down the debt, so as that the net debt would be $2,150. That's why you do that. Now, what's the implied equity value? So remember, the equity value is going to be equal to the enterprise value minus that net debt. So we just take the $7,516 minus the $2,150, and the implied equity value of this company is $5,366. Now, if you are wondering, why is it that the enterprise value is higher than the equity value, or you're not quite getting your mind around this conceptually, think about it like this. Let's say that you own a house and the value of that house is $600,000, right? So you bring in like a real estate appraiser, you ask them, what's the value of this house? They say $600,000. But you have a $200,000 mortgage associated with that house. So you actually have debt here. So you've got debt of $200,000 attached to that house. So the value of your equity is $400,000. So the house as a whole, just say, hey, forget about debt, equity, just what's the house worth? $600,000. But what is the value of your equity? That's $400,000. That's the value of the house minus the debt. So when we think about the equity value of the company, we think about, the value of the entire firm, the enterprise value, minus the net debt is the equity value, that value that pertains to those common shareholders, right, the owners of the company. Now, how will we go about finding the enterprise value? Well, you can use a discounted cash flow model with unlevered free cash flows. So you forecast a company's unlevered free cash flows into the future. And you discount them back to the present value. So I'm not going to go into too much detail here, but I just want to give you an example that I did. So we've got here unlevered free cash flow for year 1, unlevered free cash flow for year 2, year 3. So I just had a 3-year forecast horizon and forecast the unlevered free cash flow. So we'd have up here, it'd be 360. That's from right here. And then 377.5 here and so on. And then you discount it using the weighted average cost of capital, which in this example is 8%. So like this would be 1.08 to the first power, 1.08 to the second power, etc. And then beyond the 3-year horizon, you've got, all the free cash flow that's going to occur after those 3 years. So to get that terminal value that you see up here, so we say, let's take the unlevered free cash flow for that terminal year. So that's, let's see here, 400. So we've got that 400, and then we multiply that by 1 plus the growth rate, which I assume a growth rate here of 3%, so times 1.03, and then just divide that by the difference, the weighted average cost of capital, 0.08 minus 0.03, so we get 0.05 in the denominator. That's how we get this here, and then we discount that back 3 periods. So we do all this here. We build this model that tells us our enterprise value, and it's the same number from the example that I did before. So basically, the enterprise value is all the unlevered free cash flow this company is ever expected to generate discount it back to its present value. So you say, all right, there's a stream of cash flows that's going to happen. Let's discount them all back to the present value. Add it up. That is the enterprise value of the firm. But then we subtract the net debt to get the implied equity value. Now, if you say, well, I want to know that on a per share basis, what's the value of the equity per share? You would divide that by the number of common shares outstanding. So if we say implied equity value 5,366, common shares outstanding are 40, then the estimated share price for this company, the per share value of the equity, be $134.14.